let me also welcome on board our guest today, and we have Rajesh Palvia, Head Technical and Derivative Research at Axis Securities on the technical side, and we also have Mayuresh Joshi, Head Equity at Markets Mind India on the fundamental side of things. So, gentlemen, thank you so much for joining us on the show. Rajesh, I'm going to come to you first, and like I mentioned earlier, Nifty hitting record highs for 3 straight sessions. Nifty Bank above 50,000. Mid cap, small cap have also been hitting record highs. You have sectoral moves, sectors also hitting record highs. Nonetheless, Nifty has been trading slightly range bound. So, what do you have to make of this anomaly that we are seeing in the market, and what's the view going ahead into next week?
Good afternoon, Sneh. Good afternoon, everyone. So Nifty restricted its gain less than 1% week on week, but the way market behaved during the week, it was very strong buying action across the board in the so many sectors. So that clearly giving us confidence. There is a full of confidence on the street, and retailers and participants are aggressively buying in the market. The sectors where we were seeing underperformance in last couple of years, a sector like paper, fertilizer, even sugar and other sectors, now they have started participating in this rally. So looking at a broader market, we are holding our bullish view. The kind of buying action across the sector which we are witnessing, that clearly shows that this rally can extend further, and possible target for Nifty we can see towards 23,700 to 800 in the continuation of this up move. So buy on dip should be your strategy based on the derivative data. The major put writers are placed at 23,300, 23,100 strikes. So these areas are likely to act as a major support area for any kind of minor dip if happens in the market. So your stop loss should be placed at 23,200 to hold long position. On the higher side, 23,700 would be the possible target in the near term basis. On the bank Nifty, still bank Nifty is struggling to give decisive breakout above 50,000 mark. So that's the challenging level at this moment based on the call concentration. So I think if bank Nifty starts a new week above 50,000, 50,100 mark, then there would be short covering action, and then possible rally can extend to 50,500 to 50,600 for bank Nifty also. Though most of the banking stocks have shown some buying interest in this week. So I think next week we could see a rally in the banking stocks, and bank Nifty can also start contributing to this upward momentum. At this moment, yes, we are holding bullish view for bank Nifty. Your stop loss should be placed at 49,600 to hold long positions.
Okay, so you would be holding the long positions. I have another question also to you, Rajesh, but I'll come back to you. And we have Mayuresh Joshi also on the show. Mayuresh, welcome. Priyanka this side, first time talking to you on the show here. Mayuresh, but then what do we, the whole week we saw that the budget focused stocks were in action this week. You talk about infra, defense, fertilizer or cement. What should we aim at now? Should we look at these sectors scaling, achieving new heights going further?
Afternoon, Priyanka. No, I was hearing your opening remarks, both on macros and micros, and it's a pleasure to be on your show for the first time. But two things happening here. One, I think the markets are looking forward to what the probable budget announcements would or might be. Our own take at Markets with India is that the reform processes which have continued for 10 years, there would not be any significant change in terms of capital allocation for a whole host of schemes that the Modi government has embarked upon. Infra development and infra allocations is expected to double over the next 5 years. There is going to be significant allocations as far as defense is concerned. You've already heard statements related to rural and urban affordable housing. And therefore, I think roads, railways, highways, ports, infra, manufacturing, I think the capex in terms of budget allocations will continue. The second part in terms of how the markets might actually behave, post the budget, and our expectation again is that there might be no negative surprises that the budget will probably throw up. We will still continue on the path of fiscal consolidation, and therefore that should be taken positively by the markets. The additional 1 lakh crore also gives sufficient amount of elbow room and headroom for the government to probably play around with in terms of both allocations towards infra as well as reducing the fiscal deficit in general. So to that extent, a lot of freebies which are expected by the market, which was the fear, I think should not come through. I think it should be a more prudent allocation as far as the budget is concerned. And therefore, we'll head back to earnings. And earnings are expected to hold up in the 12 to 14% range. Domestic cyclicals is something that will still continue doing well. And a whole host of sectors. You pointed that out. You've seen huge moves continue in sectors like defense, railways. But in our opinion, I think selective stocks within the infra theme, cement theme, water treatment, water allocation, I think that could be a big theme for the budget as well, is something to be looked out for. Consumer staples discretionary both selectively should start doing well with good monsoons expected. Rural recovery in real earnings should start coming through in the second half, which will give a huge leg up for these segments of the market as well. So I think more focused on the domestic areas at this juncture. Our take is that a balanced and a mixed approach in terms of your portfolio, including some stocks from pharma, can absolutely hedge the aggressiveness in the domestic cyclical overweights that you probably got. So remain optimistic on the markets.
Mayuresh Joshi on the fundamental side. On technical side, we have Rajesh Palvia. Rajesh, I heard you were saying that you would be long from here. And there's one more reason to it. Of course, FIs have significantly come down on the short positions from 3.4 lakh contracts. Now their short position is merely 34,000. What do this indicate? Are we in for more higher levels? FIs can turn bigger buyers because at least the selling has stopped. The quantum of buying is not that significant, but at least the selling has stopped.
So Priyanka, if we look at the last 5-6 month data, FIs were absent in the market, and this really is led by the domestic participant. I think they have cut down their short position. So again, this is again showing that there is a pain on their short position. That's why they are cutting down their short position. And I think if FIs are not doing short position at this moment, so the retailers are participating in this market, and they are quite bullish on the market. So I think domestic flows are driving this market at this moment. And the way we are seeing that incremental growth in SIP flows and other avenues, so I think that is likely to continue further, and we believe that this trajectory can continue further more higher, though FIs are not buying in the market at this moment also. So I think domestic flows can drive the rally, as most of the domestic themes are playing out in this market. So that clearly shows that everybody is optimistic towards the growth trajectory of Indian economy, and that's why this is the sign of the continuity of this bull market.
Thanks for that view coming in. Mayuresh, I'm going to come to you, and I want to get a little sector specific here. Let's talk about 3 sectors in focus. First, on the gaining side, you have the real estate space, right? Do you still see more legs to this rally given that the PMAY has been extended? And on the flip side, you've seen FMCG and IT being the top laggards today, and I can't help but notice that the top Nifty 50 losers, 4 out of 5 are from your FMCG and IT, likes of HUL, Infosys, Tata Consumer and ITC. What's your outlook for this space going ahead, as well as do you see more legs to the rally when it comes to real estate?
So I think it's a natural trend. If the market is in momentum, I think a lot of these defensive spaces go into a relaxed mode, right? So to that extent, I think how the monsoons play out and what the initial signs are being seen of a very normal monsoon this time around, above average in some areas as well. I think you might expect a decent rebound as far as rural incomes are concerned. Rural is still a large part of FMCG sales, and therefore, as rural incomes will start coming back, and there is a definite trend of discretionary spending coming back to the forefront, you will see volumes pick up quite significantly. So I think a lot of ad spends that is happening, a lot of grammage increases that is happening without any price increases might just normalize, leading to better numbers from the second half for a lot of these FMCG players. For reality as a space, I think we're still going through that 6-year cycle in the third and the fourth year, 2 years still to go. historically as we've seen real estate cycles play out. Pre-sales velocity for most players, you've seen launches by DLF getting sold off in a week. A few launches by Soba, as an example, have got sold out. There was a launch by Kolte Patil in Pune, which got sold out in a matter of weeks. And therefore, I think the appetite in terms of premium and sub and above par properties, which is above notional values, which an average investor probably pays, is still looking very, very good. And to that extent, I think real estate developers have done well. But real estate ancillaries is something that one should now start focusing upon. Greenlam Laminate, Century Ply is an example, right? They're just about right at this juncture. They've gone through a lot of input cost inflation pain in the past few quarters. Volumes will come back because as new houses are now getting built, you'll obviously need refurbishment happening in those new houses, and existing houses will continue their mode of refurbishment as well. So I think real estate proxies, ancillary stocks might do well. For IT sector as a whole, my whole take is that wait out for Q1 numbers. Mid cap IT relatively better fared compared to large cap. Order flows have remained consistent, margins have remained consistent, commentaries related to both revenue growth as well as pricing have remained consistent as well. The valuation and late stage basis is something one needs to comprehend with. But for large cap IT in general, I think what probably happens with three of the biggest spaces, BFSI is still going through some element of pain in North America. Retail and manufacturing, both in the Euro context and the American context, should start showing signs of recovery in the second half. There might be some element in terms of frothiness as far as pricing and orders are concerned. So wait out for numbers for Q1 for large cap IT, but anybody holding mid cap IT can continue.
Hear you, Mayuresh, mid-cap IT, and you also mentioned about real estate, building material, and the real estate proxies. Okay, Rajesh, coming to you, one last question. What would be your recommendations for the coming week?
So first stock is from the pharma space. Cipla is the on our radar. Stock is now at all-time high trajectory. The way stock managed to give breakout of last 3-week consolidation, that clearly shows that there is a continuity of the uptrend. We believe that Cipla can continue furthermore upside towards 1620. One can buy this stock with stop loss of 1530. The second stock is JSW Energy. Stock managed to view breakout of its multiple supply zone on the daily chart. Stock is almost enjoying its all-time high trajectory. So JSW is looking bullish. Technical structure on weekly as well as on the daily is showing that this momentum can extend further. Upside target we are projecting towards 710. Keep your stop loss at around 668. And the third stock, which is Triveni Engineering. Most of the sugar stocks have done well, and Triveni Engineering again, looking very promising. The way stock managed to view breakout of almost 7-8 week consolidation, that clearly shows that here we can see a follow-up buying action in coming week. Possible target we can see towards 425. Triveni Engineering is buy with stop loss of 388.
All right, Rajesh, thanks for that view coming in on the technicals. And gentlemen, thank you both so much for joining us today and taking the time out. But on that note, Mayuresh and Rajesh, we'll let you go. Thanks so much for joining us.
If you like this video, then like, share and subscribe to ET Now.